So we're going to get into investing here. And this is my favorite section. I love investing because investing is how you build wealth. This is how you grow your money. This is how you get to live the life that you dream of. This is how you put all that hard work that you've been putting in at work. This is how it pays off. So regardless of your age, doesn't matter where you are right now, you can save money and invest and leverage investing to build long-term wealth. And one thing to keep in mind about investing is that, as I mentioned, it allows you to grow your money. And depending on how much you invest, you can accelerate your timeline to retire early. So you may have heard of financial independence, retiring early. uh, you can be able to work at a reduced schedule if that is your choice. If you're able to invest and build wealth, you can take a sabbatical, you can leave a job that does not serve you, you can help your family and community, and you could also create generational wealth. So investing is something that is incredibly important for us to do to build wealth beyond ourselves, beyond of us simply exchanging our time for money, because we cannot work our way to wealth. We cannot exchange our time for money and expect to build wealth, because we only have so much time in a day, right? Anybody who has successfully built wealth has done it by having their money work for them, whether that is in real estate, in stock market, in business, but not by direct exchanging 1 hour for a certain dollar amount. Um, because when you're investing, your money can be working for you while you're sleeping, right? And can take advantage of the power of compounding and appreciation and dividends. So bottom line is that investing gives you options. So people always ask me, well, I always hear about investing in the stock market. What other ways are there to invest long term? So again, investing in the stock market is a great way to invest because it's one of the lowest barriers to entry. You don't need a lot of money to get started with investing in the stock market. And for a lot of people, their first entry is with retirement plans, right? 401k, 403b, IRAs, traditional IRA, the Roth IRA. And you can also invest in non-retirement accounts, right, that you set up yourself. So with a brokerage like Fidelity or T. Rowe Price or Merrill Lynch, for example. Another avenue to invest in the stock market is through real estate. This is through rental or commercial property. You can get into farmland. You can get into hospitality. There's so many different ways to invest in real estate. You can be a landlord. You can buy a building, a car wash, laundromat, etc. And then the third way is small business. This is when you start your own business and you have a product or service that you sell, or investing in the business of other people, being an investor in a business that you believe can grow, or now becoming more prevalent, digital currencies and assets. So these are cryptocurrencies, NFTs, and etc. So there's many different ways to invest. And when you look at the truly wealthy, they diversify their investments. So they have investments in multiple avenues across each of these four categories. So there are these four categories, and then within each of these four categories, there are multiple other categories. So for example, in the stock market, you can invest in index funds and ETFs and individual funds, in bonds, for example, right? And as I mentioned, I gave examples of real estate, small business, and then digital currencies. And there are different types of cryptocurrencies and now digital assets, etc. So these are all areas that you can start to research, start to explore. Tons of books, tons of podcasts. Educate yourself on what interests you. You must do your research before you step into any kind of investment whatsoever. So I'm just going to take a sip of my drink here. One thing to keep in mind when you're investing is there are a lot of opportunities to make investing mistakes, right? And we all make mistakes when it comes to money. I admitted this at the beginning of the session. However, there are mistakes that we can avoid, right? So number one is not having clear objectives. And an objective is in investing is, what are you investing for? What is your timeline? When are you going to need this money? Why are you investing? You need to know what your objective is, because that helps you determine how much risk you take on. If you need the money in 10 years for a specific thing, then you want to be mindful of what type of investments you get into. You need the money next year. You want to be mindful about what type of investments you get into. So you need to have objectives. What are you investing for? A child's college education, to buy a house in 10 years, to move to a new city or a new country. Be very clear. You also want to know your risk tolerance. This is essentially what type of investments is going to cause you to lose sleep at night. So, for example, cryptocurrency, highly volatile, very interesting, very new investment, lots of potential, but highly volatile. So, if your investment were to drop 60%, by tomorrow morning. Will it bother you? That is understanding your risk tolerance. The other thing is trying to time the market. Timing the market is a fool's errand because even the best stock analysts cannot predict the future. So I love the Warren Buffett approach to investing is investing for the long term, giving your money and your investments the opportunity to take advantage of compounding, appreciation, and dividends, and not trying to buy low today and sell high by tomorrow morning and day trading and all that kind of stuff. Because again, you know, in the stock market, we're working against algorithms and really, really robust algorithms. And as a human being, it's really hard for us to compute all those determinations and forecasts to beat the algorithm. And so most people that try to time the market lose a lot of money. The other thing is investing in emotion, right? The stock market does not care how you feel. Real estate does not care how you feel when you're investing. So you don't want to invest because you're happy, because you're sad, because you're so excited, because your uncle's best friend said that this is going to be a killer stock and going to make you lots of money. You want to invest based on research. And the last point here is not doing the necessary research. You don't need to be the Jim Cramer of the stock market. You just need to understand, what am I putting my money into? What is it going to cost me? Um, how has this investment performed historically? What are some risks I should be aware of? You want to do that research. And when you think about anything you want to invest in, you can get that investor's document. You can get that prospectus from any valid investment you're trying to make, any company website, any fund's website. You should be able to go to that website on the internet and download those documentation and read about the history of the business, the history of the investment, how they have performed. You can Google in the media to see what financial issues they have had, what other types of issues have been talked about in the news, right? And also invest in what you know. If you love Costco, that's a great place to start, right? Go to the website, download their prospectus, read about them, see what's being said in the news. As you shop in the store, have their products changed? Are people complaining more? The line's super long? Are they getting super rude? These are all opportunities to research what you want to invest in. And I would say that if you are a new investor, you want to consider investing in funds versus individual stocks simply because of broad diversification, right? You're able to spread your money across multiple industries and asset classes, and it's essentially not putting all of your eggs in one basket. So I talked a little bit about this, but when it comes to investing in the stock market, most people, their first entry is through an employer sponsored account or an IRA. However, I also mentioned that you can invest independently through a Fidelity, a Vanguard, a Charles Schwab. When you are picking a brokerage to invest, consider the minimum cost to invest, consider the customer service. That is a big one for me, and consider the research tools. And as I mentioned, it's a good idea to keep things simple and invest in funds as opposed to multiple individual stocks. Um, I would also say that it's a good idea to invest in platforms that are well known. I have nothing against startup investment platforms, but sometimes they don't have all the benefits from a bigger platform. So I had invested some money in a smaller investment firm that's quite popular, but they're not nearly as big as a Fidelity, Vanguard, Charles Schwab. And when I wanted to close the account, it took them about 120 days to give my money back to me. Whereas with Fidelity, I'd gotten my money in a matter of a week after they had sold the asset. So very important to keep that in mind. So investing tips. Investing is not a get rich quick scheme. So anyone that's selling you invest now, be rich by next week, block them, run away. Tell them to stop it. Investing for the long term requires patience, and you need to have a plan and a timeline. And when it comes to the stock market, understand that the market is cyclical. So everybody is crying about how poorly the stock market is doing right now. But like, as Warren Buffett would say, this is the stock market on sale, and who doesn't want a good sale? So this is a great time to buy. The market is going to dip and spike, right, with political climates, with recessions, with global politics, all kinds of things. But historically, after inflation, the returns on the stock market are about 8%, which beats any high yield savings account. I think the average interest rate right now, after the Fed raised rates, is about 2%. And that doesn't even beat current inflation, which is somewhere around 5 to 6% right now. So investing in the stock market is a great way over the long term to have your money grow and work for you. If you invest in an employer sponsored plan and they offer a match, please take that match. That is free money. That is a 100% return on your investment. Contribute enough to get the full amount of the match, and then build that into your budget. Get the full match. Free money, free money. I love employer matches, right? Because it is free money. So Faith said we match 50% up to 4% currently. So everyone who is on this call that's employed at your company, you need to be contributing enough, at least 4%, to get that 50% match. It's free money. So when it comes to picking funds, I talked about investing in funds, so things like index funds. Look at the spread of investment sector. So I like the S&P 500 because that's an investment in the 500 biggest corporations in the United States. So that's a great place to start, and they are broadly diversified. But if you're choosing to invest in other types of funds, look at the spread of investment sectors: technology, financial, healthcare, consumer staples, consumer discretionary. You want to have that fund spread across those. And then look at expense ratios, which is essentially how much is it going to cost you? How much are they going to take out of your account every year to maintain your investment in the fund? And so, index funds typically have the lowest expense ratios, while mutual funds have the highest expense ratios. And the difference between an index fund and a mutual fund is an index fund simply tracks an existing benchmark. So, for example, you can invest in an index fund that tracks the S&P 500, right, which is these 500 largest corporations in the U.S. Whereas, an index fund just basically invests in those companies. Mutual fund, on the other hand, has an actual mutual fund manager, and their goal is to put your money in investments that are going to beat the market or reach certain expectations. However, studies have shown that mutual funds over the long term don't perform as well as index funds, and they cost more money because you're paying this fund manager's high salary. So you guys may have heard of Bernie Madoff. He was a fund manager, for example. If you do choose to invest in a mutual fund, so for example, you may be in an employer plan and the only options in the employer plan are mutual funds. That is fine. Get the free match. But still do your research to know what your best option is amongst the funds that are being offered to you. So look at a fund manager's track record. You can actually find, if you find the name of your fund, put it in Google, it'll show you your fund manager. And you can look them up on LinkedIn. You can see where they went to college. You can see how they performed at their previous jobs. You can see what people are saying about them in the media. Okay. And then when it comes to an investing prospectus, so if you're investing in your employer's plan, you will always get a prospectus via email or in the mail about your investments. And even if you invest with a Fidelity or T. Rowe Price, you will also get a prospectus in the mail, or you can go to the website and download it. And this is just basically information about your investments. So prospectuses can be they can be overwhelming, they can be complicated, they can be confusing, but there's key things you want to look for if you choose to read a prospectus. Number one, how much are you going to pay the fund if they're managing your money? What kind of returns has the fund delivered for investors in the past? What is the fund composed of, its sectors and its top holdings? And then what is the fund's objective and strategy to achieve results? This is all information that is laid out in a prospectus, and you can just go over to those points in the table of contents. During times of uncertainty, it is okay to pause making any investments until you have an emergency savings in place that you feel comfortable with. It is also important that if you continue to invest, that you think long term and you keep your objectives and your risk tolerance in mind. Investing is long term. Definitely don't get caught up in the hype on social media of what is the hottest investment. Stick to your goals, stick to your long term focus, and keep your risk tolerance in mind.